Investing doesn't have to be a gamble. It's about making informed decisions, understanding the basics, and building a secure financial future. This is your definitive guide to investing without fear, even if you're starting from scratch. The information provided in this video is for educational purposes only and should not be considered financial advice. We are not financial advisors. All investment decisions should be made with the help of a qualified professional, and you are responsible for your own investment decisions and any potential losses. Section 1. The power of investing and why you shouldn't be afraid. Many people are intimidated by the idea of investing. They see it as complex, risky, or something only for the wealthy. But the truth is, investing is one of the most powerful tools you have to build wealth over time. It's about making your money work for you, not just trading your time for money. Think about it. Inflation constantly erodes the value of your savings. Money sitting in a bank account often loses purchasing power over time. Investing, on the other hand, offers the potential for your money to grow, outpacing inflation and creating real wealth. The key is to approach investing with knowledge and a plan, not with fear. This guide will equip you with the foundational understanding you need to start your investment journey confidently. Section 2. Before you invest. Setting the stage for success. Before you even think about buying your first stock or bond, there are a few crucial steps to take. Define your financial goals. Why are you investing? Is it for retirement, a down payment on a house, your children's education, or simply to grow your wealth? Having clear goals will help you determine your investment strategy and time horizon. Create a budget and manage debt. You need to know where your money is going. A budget helps you track your income and expenses, identifying areas where you can save and invest. Prioritize paying off high-interest debt, like credit cards, before making significant investments. This is often the best guaranteed return you can get. Build an emergency fund. Life is unpredictable. An emergency fund, typically 3 to 6 months of living expenses, in a readily accessible savings account will prevent you from having to sell your investments prematurely if unexpected costs arise. Understand your risk tolerance. How comfortable are you with the possibility of losing money in the short term for the potential of higher long-term gains? Your risk tolerance will influence the types of investments you choose. Generally, younger investors with a longer time horizon can afford to take on more risk. Section 3. Core investment concepts for beginners. Let's demystify some common investment terms. Stocks, equities. When you buy a stock, you're buying a piece of ownership in a company. If the company does well, the value of your stock may increase, and you might receive dividends, a share of the profits. Stocks offer the potential for high returns but also come with higher risk. Bonds, fixed income. When you buy a bond, you're essentially lending money to a government or corporation. In return, they promise to pay you back the principal amount plus interest over a set period. Bonds are generally considered less risky than stocks, but typically offer lower returns. Mutual funds and ETFs, exchange-traded funds. These are collections of stocks, bonds, or other assets managed by professionals. They offer instant diversification, which means you're spreading your risk across many different investments. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. Diversification. Don't put all your eggs in one basket. Diversification means spreading your investments across different asset classes, stocks, bonds, real estate, etc., and within those classes, different companies, industries, and geographies. This helps reduce risk. Compounding. This is the magic of investing. It's when your investment earnings start generating their own earnings. Over the long term, compounding can have a massive impact on your wealth. Section 4. Getting started. Your first investment step. Okay, you've done your homework. Now what? Choose a brokerage account. You'll need an account to buy and sell investments. There are many reputable online brokers that offer low fees, educational resources, and user-friendly platforms. Some popular options in the US include Fidelity, Vanguard, Charles Schwab, and others. Research and compare their features and fees. Start small and be consistent. You don't need a lot of money to start investing. Many brokers offer commission-free trades and allow you to buy fractional shares. The key is to start even with a small amount and invest regularly, e.g. monthly. This is called dollar cost averaging, and it helps reduce the impact of market volatility. Consider index funds or ETFs for beginners. For most beginners, low-cost index funds or ETFs that track a broad market index, like the S&P 500, are an excellent starting point. They offer instant diversification and have historically provided solid long-term returns. Focus on the long term. Investing is a marathon, not a sprint. Don't get caught up in short-term market fluctuations. Stick to your long-term plan and avoid making emotional decisions based on fear or greed. Keep learning. The world of investing is constantly evolving. Stay informed by reading reputable financial news, books, and resources. The more you learn, the more confident you'll become. Section 5. Common pitfalls to avoid: timing the market. Trying to predict short-term market movements is nearly impossible and often leads to poor results. It's time in the market, not timing the market, that matters. Chasing hot stocks. Don't invest in a company just because you heard about it on social media or because it's had a recent surge in price. Do your own research and understand the fundamentals. Letting emotions drive decisions. Fear and greed are an investor's worst enemies. Stick to your plan and avoid making impulsive decisions based on market noise. Ignoring fees. High fees can significantly erode your investment returns over time. Pay attention to expense ratios, trading commissions, and other costs, not rebalancing your portfolio. Over time, your asset allocation may drift away from your target. Periodically rebalance your portfolio to ensure it aligns with your goals and risk tolerance. Section 6. The power of patience and consistency. Building wealth through investing takes time and discipline. There will be ups and downs in the market, but history has shown that, over the long term, a well-diversified portfolio has the potential to generate significant returns. Don't be discouraged by short-term setbacks. Stay focused on your long-term goals, keep learning, and be consistent with your contributions. The power of compounding will work in your favor over time. You've taken the first and most important step by seeking out this knowledge. Now, it's time to take action. Start small, be patient, and remember that investing is a journey, not a destination. You have the power to build a brighter financial future starting today.